Gold. Up $10, sitting at 4,267.16. But before you even think about buying this dip, look at the chart. Look at the bigger picture. The Fed just left rates unchanged, and they did it with a hawkish punch that is sending shockwaves through the precious metals complex. There is a trap being set in this market right now, a divergence that is screaming exhaustion, and a hidden opportunity for those who can see it. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, from the conservative sniper shot to the high-risk aggression play. Here is the instant marker verdict. Gold is in a trending bearish structure on the higher timeframes, but we are range-bound on the intraday. The bias is to sell rallies, not buy dips. There is one single invalidation level that flips this entire bearish structure on its head. Write this number down. 43.29. That is the daily pivot point. If we see a strong, impulsive 1H or 4H candle close above 43.29, the entire structure resets. It invalidates the immediate bearish outlook and points to a retest of 4,356. Until then, the path of least resistance is lower. The herd is positioned for a bounce. Everyone is looking at the safe haven bid after the Federation. But they are wrong. They're holding long positions from higher levels, and they are about to get squeezed out as momentum shifts. Let's step back and read the chart from the top down. The weekly trend is a sell. The daily trend is a strong sell. This is the first thing you need to understand. We are not in a bull market. This is a structural correction. Now, dive into the daily time frame and look at those moving averages. The MA50 is sitting at 45.21, the MA100 at 45.50, and the MA200 at 43.72. Price is already well below all of them, confirming the bearish regime. The daily MA20 is at 4,366, acting as a massive overhead resistance zone. It's a brick wall. On the 4H chart, which is the heartbeat of this market, we see a clear bearish alignment. The 4H MA20, MA60, and MA200 are stacked in that order, all sloping downwards. Price is currently trading below all of them. This is the blueprint for a sell the rally strategy. Now, let's talk about momentum. The MACD on the daily chart is a major problem for the bulls. It is flashing a strong sell signal. More importantly, look at this 4H negative divergence. Price has made a slightly higher low in the last few days, but the MACD histogram is making a lower high. That is textbook exhaustion. Buyers are getting weaker with each bounce. This brings us to the levels that matter. The precise support levels are clear. S1 is 43.04, S2 is 42.78, and S3 is 42.52. The immediate resistance is a 1 at 43.56, with a more significant barrier at R2 of 4,381. We are currently sitting at the S1-S2 support zone. This is where the trap is set. Here's what most traders miss. They see a drop to support and automatically think buy. But they ignore the structure. The structure is broken. The moving averages are all above us, forming a ceiling. And the MACD is diverging. This isn't a bounce zone, it's a potential breakdown zone now. Connect the dots. The fundamental driver is the Federal Reserve. Yesterday's hawkish hold changed everything. They left rates unchanged, which was expected, but they signaled no rush to cut. They are hawkish, and that's driving real yields higher. Gold is moving tick for tick with real yields. As real yields rise, the opportunity cost of holding non-yielding gold increases. That is the fundamental gravity pulling gold down. This isn't just about gold. It's a dollar story. The US dollar to Japanese yen is squeezing higher, the DXY is firm, and that is a headwind for the entire commodity space. From here, our 1 to 2 week directional lean is bearish. I expect a test of the 4,250 level, and potentially lower, over the next 2 weeks. The event that invalidates this bearish view is a sudden dovish pivot from a Fed speaker, but we haven't heard that rhetoric yet. Another event to watch is a geopolitical escalation, but for now, The hawkish Fed is the dominant narrative. Do you think gold breaks 42.50 this week? Comment yes or no in the comment section right now. I'm tracking institutional consensus, and I want to see if you're aligned. Most people skip this section. That's exactly where the money is made. Keep watching. Here are 3 exact trade plans based on today's price action. Strategy 1, the sniper, conservative. For the conservative trader, we are looking for a clean continuation trade. We wait for a retest of the breakdown level. The exact trigger is a 1H candle that closes below the S1 level at 43.04. This signals a breakdown is real and accelerating. You enter the trade on the next candle's open. Your stop loss is placed just above the pivot point at 43.35. This gives you a buffer against a fakeout. Target 1 is S2 at 42.78, and target 2 is a full retest of S3 at 42.52. The risk-reward ratio is exceptional, over 2 to 1. This setup is voided immediately if the 1H candle sees a strong bullish reversal and closes above 43.29. The sniper, conservative, entry, 4,304, 1H close below, stop loss, 43.35 take profit 1, 42.78 take profit 2, 42.52 risk, reward, 1:2.3 are invalidation, void if 1H close above 43.29. Strategy 2, the active trader, standard. The active trader strategy is a mean reversion play in a defined range. We are looking for the price to return to the pivot point at 4,329 and show signs of rejection. The entry condition is a bearish engulfing candle or a clear pin bar on the 15-minute or 1H timeframe that closes below 43.29. This is a classic sell the rally from a key resistance level. Your stop loss is placed just above the 4H resistance at 43.56. Target 1 is a quick move back to the S1 support at 43.04. Once target 1 is hit, you move your stop loss to break even and let target 2 run to 42.78. This strategy provides a solid risk reward and keeps you active in the market. Type your gold range for tomorrow in the comments now. Let's see who's aligned. The active trader. Standard, entry, 43.29, bearish reversal confirmation, stop loss, 43.56 take profit 1, 43.04 take profit 2, 42.78 risk, reward, 1:1.8 are invalidation, void if 1H close above 43.56. Strategy 3, the aggressor, high risk. For the aggressive trader, this is a momentum chase. We are looking for a fast, sharp breakdown through the S2 support at 42.78. The trigger is not just a touch, but a strong 15-minute candle that closes decisively below 42.78. This indicates a panic flush is underway. You enter immediately on the close of that 15-minute candle. Your stop loss is a tight $10 above the breakdown level at 42.88. Target 1 is the S3 at 42.52, which you can take profits aggressively on. Target 2, if price accelerates, is 42.30. This strategy is only for those who can lose small and manage risk aggressively, because if it's a fakeout, the bounce can be violent. The aggressor, high risk, entry, 4,278, 15M close below, stop loss, 42.88 take profit 1, 42.52 take profit 2, 42.30 risk, reward, 1:2.6 are invalidation, void if price bounces back above 43.04. Never risk more than 1 to 2% per trade. No positions through high-impact news, like the upcoming US data. Stops are non-negotiable. The market has a way of punishing those who don't respect risk management. This is how you survive to trade the next big move. To wrap it up, the single most critical level for the next session is 4,329. That pivot point is the fence. As long as we are below it, the pressure is to the downside towards 42.52 and beyond. Tomorrow, we'll be focusing on the euro to US dollar and its battle with the US dollar index, a correlation that's key to this gold trade. If you want the full breakdown on the entire 8-asset portfolio and how the risk asset shadow is moving the markets, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.